Hey, it's John from stopsaving.com and welcome to the next video in our course on Technical Analysis Simplified. In this video, we're going to talk about price compression patterns. These can form an important part of your trading strategy because they can tell you when to be on the lookout for a big volatile price move. We'll cover wedges, triangles, pennants, and flags, as well as some of the less obvious types of compression pattern shapes. So on that note, let's jump in. And here's what you'll learn in this video. Number 1, what price compression patterns are. 2, what price compression patterns can tell you about the nature of a trend. And finally, number 3, common price compression patterns and how to use them in your strategy. So let's now move on to the first question that we'll answer in this video, which is, what exactly are price compression patterns? Well, they're chart formations where the price range becomes narrower over time. In other words, the price compresses into a tighter and tighter trading range. When this happens, trading volume often decreases as the patterns form, and that shows decreasing interest in the asset. And usually, price compression patterns are the calm before the storm. They show indecision among investors before a big decision, and a big price move in favor of either buyers or sellers once that decision is made. Price compression patterns can have clean shapes like wedges, triangles, flags, or pennants, but in reality, compression patterns can often be very messy. We're going to look at many different examples of compression patterns in this video. As always, we'll use real examples of different price charts to explain them because that's the best way to learn. So to start off with, let's look at two common types of compression patterns, and that's wedges and triangles. Let's begin with the falling wedge. Now, more often than not, these patterns tend to break to the upside. So here's a blank one-day chart of Bitcoin when it bottomed in July of 2021, after a pretty big move to the downside earlier on in the year. Notice that from late May through to the end of July, sellers pushed the price down to lower lows. But also notice that they did this with less force each time. And we can see that if we connect the lows based on the daily candle closes over here. The price then began to wedge itself into a balance between buyers and sellers. So the price was still technically in a downtrend, making lower highs and lower lows, but it was compressing into a tighter and tighter range each time. As often happens with falling wedge patterns, sellers get exhausted, and at some point, all the sellers who would have sold have already sold. And at that point, buyers gain the upper hand, and this causes the price to break above the wedge. Now, as with all patterns we will cover in this video, there are two ways to trade them. The first is the range trade. Here, you would buy near the bottom of the wedge and sell or short near the top of the wedge. If the pattern is clearly established, this can be a good strategy to trade while the price is compressing into the pattern. Then there's the swing trade. Since this is a daily chart, in this case, you'd buy when the price closes a daily candle above the top of the wedge. And then you'd pretty much stay in your trade until the price starts to consolidate again. With swing trades, you'd have fewer opportunities than you would with the range trade, but that opportunity could involve a bigger move. This is why some traders might range trade while the price is consolidating and then switch to swing trading once the range has been broken. Now, keep in mind that falling wedges can also break to the downside rather than to the upside, which is more common. So if they do break to the downside, the strategy would be to enter a swing trade by shorting the asset instead. Here's another example of a falling wedge, and this one's for the Van Eck Vectors Gold Miners ETF, and that's ticker GDX in TradingView. Here's the wedge in dark teal, and there's the breakout in grey. Let's now look at a rising wedge. Here we're looking at the Bitcoin one-day chart again, and in this case, a rising wedge would have alerted us to start selling Bitcoin near the top of early 2021. So with a rising wedge, buyers push the price up, and although the price keeps making higher highs, the highs are only slightly higher each time, suggesting that buyers are running out of strength. The price is also making higher lows, but then starts to wedge itself into a balance between sellers and buyers. This also shows that the uptrend is getting weaker. More often than not, the price breaks to the downside of the wedge as sellers take control. And in this case, range traders would buy near the bottom of the wedge and sell or short near the top of it. And swing traders would wait for a daily candle close below the bottom of the wedge to take a short position. Notice how the price also retested the bottom of the wedge before going down. And here's another rising wedge a bit later on, and this led to an even bigger drop in the price. Let's now move on to triangle patterns, starting with an ascending triangle for Ether on the one-day chart. Here's how to understand ascending triangles in terms of buyer and seller demand. First, buyers push the price up to a ceiling like this. Sellers push the price back down each time, but with less strength. And that's because the price makes higher lows each time the sellers push it down. So what you have here is a clear sign that buyers are getting stronger relative to sellers. And the more times buyers try to break through a ceiling, the more chance there is that they will eventually break through it. And that's what happened here, as the price broke through the ceiling and blasted higher. For range trading, it's the same as with any pattern. Buy near the bottom of the range and sell or short near the top of it. For swing trading, you could buy or sell after a candle close outside of the triangle. Ascending triangles tend to break to the upside more than the downside, and that's what we see in this example. Also notice how the price came back down to retest the top of the range after it broke out, and that would have been another great time to buy. And here's another ascending triangle for Ether on the one-day chart. This one did not retest the top of the triangle before breaking out. Now, ascending triangles tend to be bullish because the price is making higher lows and eventually breaks through the ceiling. But descending triangles are the opposite. Here we have the Japanese yen priced in US dollars, and that's the JPY USD trading pair, and we're using the 1 week chart. First, sellers push the price down to a floor. Buyers then push the price back up with force, but with less strength each time since the price is making a series of lower highs. Often, the price breaks the floor and moves lower, i.e. the selling pressure eventually overpowers the buying pressure. Range traders will buy and sell the range like this, and swing traders will try go short with a candle close below the bottom of the range like this. So that's it for wedges and triangles. In our next examples, we'll look at pennants and flags. These are classic continuation patterns that you'll often see after a strong move in the price. Okay, so starting with the bull pennant. And for this one, we've picked none other than Pepe the meme coin. That's Pepe USDT on the 4-hour chart. Now, as I mentioned in the last slide, with pennants and flags, you usually have a strong move before the compression pattern starts. And we can see that here with Pepe. After the price has had such a strong move, it then needs to cool off a bit. So it starts to consolidate into a pennant shape. Eventually, buy and sell pressure move into an equilibrium. And finally, the price breaks through the top of the pennant for the next leg higher. Range traders will range trade, and swing traders will swing trade. Of course, pennants can be bearish too, and that's what we have here with the Scottish Mortgage Trust, that's SMT 1 week chart. First, sellers push the price down in a strong move. The price bounces but fails to turn into an uptrend, forming a pennant shape. It then breaks down and continues lower. And here's the range trade, and then the swing trade. Let's now move on to flags. And for this example, we're looking at a bull flag on the Phantom 4-hour chart. With flags, the same logic applies as with pennants. They happen after a big price move, and they often tend to lead to continuation of that move in the same direction. The only difference is the pattern. A flag looks more like a channel than a pennant. After the price has consolidated in a flag for long enough time, it becomes clear that buyers are still buying the dips, and sellers are simply not strong enough to push the price down. And while a bull flag can be downward sloping, like this one, notice that the downtrend is nowhere near as steep as the uptrend that came before it. Another sign that sell pressure can't take over buy pressure on the way down. Eventually, once sellers have tried their best to push the price down but failed, a bull flag often breaks to the upside. Range traders do this, and swing traders do that. And now for bear flags. This time we're using the 1-day chart of polka dot or dot. This is a similar idea to the bear pennant. First, there's a big move down. Then a weak uptrend in the shape of a flag. And finally, once the buyers have run out of bullets, the sellers fire the final round down. Here's the range trade, and here's the swing trade. By now you've seen a lot of different patterns with clear shapes, but in reality, price compression patterns can get very messy. So to wrap up this video, I'll now go over a few examples of this. Here's the Dogecoin 1-day chart. At the bottom, you can see the price is compressing as volatility is decreasing. Essentially, investors are losing interest in Dogecoin and the price is showing it. And then things get really dull. But as the saying goes, never short a dull market. You see, when the market is dull like this, especially after a slowing decline in the price, all the sellers who would have sold have probably already left the market, so it doesn't take much buying pressure to flip the script and then cause the price to go up. And here's another example with Avalanche's AVAX token on the 1-day chart. Now, if you recall the last video on trend lines, a good way to play this might have been to buy Avalanche after it broke the top downward trend line. Here's another messy compression example, and this one's using the Render 1-day chart. First, there's a big move higher. Then the price starts to consolidate. Now, it sort of looks like a falling wedge, but it deviates below the wedge for a time in March. Still, the general idea is that there's a consolidation towards an eventual resolution. And in this case, that happens to be with another leg higher for the token. Again, you could have bought on a downward trendline break at the top of the trendline. So let's now recap what we've covered in this video. Number 1, compression patterns show a slowdown of a trend, where buy and sell pressure level out. 2, it's usually the calm before the storm, and is often followed by a big move in one direction. 3, wedges, triangles, pennants, and flags are common compression patterns, but often compression is messy. And finally, number 4, don't worry about memorizing each pattern. Rather understand what the pattern is signaling about the balance of buy and sell pressure. So that's it for price compression. This shows us when the trend is slowing down. In our next video, we'll look at bottoming patterns to help you decide when might be the right time to buy the dip. So thanks for watching, and I'll see you in the next video.